As a step one, I think it's very important to search for quality versus yield. If you research, you will find companies that are paying 10-15% dividends, but you want to look under the hood. You always want to go for quality and future earnings versus the yield that they're providing at the moment. Make sure if you pick a company, you want to pick a company that has a strong business model and you feel that in 10 years, 20 years time, this company will do very well. You don't want to look for a company that pays a high yield but is dropping 20% every year because their business model is simply not sustainable or they have a high level of debt to provide this yield. So this is the first step to look at. Next, you want to make sure that you diversify across different sectors. In the stock market, we differentiate between 11 sectors. And depending how you want to position your portfolio, you want to select certain sectors and maybe overweight in certain sectors. But in the end, it is important to diversify across all different sectors because the different sectors will perform differently in different economic times. So, for example, utility and healthcare will do very well during a recession because, in the end, people still need to go to a hospital, people still need to pay their electricity bills. And for example, maybe they will spend less on consumer discretionary during this time. So you want to make sure that you diversify accordingly. And as well, from a diversification perspective, you don't want to just put all your bets on one company. You as well want to diversify across multiple companies in case one is going out of business or it's just less profitable than what you thought. And as well, it is important to diversify across regions. Of course, if you're a US-based investor, maybe you want to be overweight in the United States, but you should always look into international markets as well because various economies will do differently at a time. And obviously, as well, asset prices are influenced by currencies. So, for example, if the dollar is weakening, other asset prices will go up. So, there's something to keep in mind. At the next step, you want to research your companies you want to invest in. A website that I would suggest is seekingalpha.com. Even without registering, they have a free registration, but even without registering, you can look up companies. So, for example, here on the screen, you can see Pepsi. And what is important to look not only the dividend yield and the stock price, but also look at dividend growth history. So, as you can see for Pepsi, they were growing their dividend for the last 47 years. And as well, over the last 5 or 10 years, they were growing the dividends at the rate of roughly 8% per year, which is very good. So you want to make sure that you select a company that is growing its dividends and doesn't stop paying dividends in certain periods of time or reducing them. Next up, what is very important is dividend safety as well. So you want to invest in companies that have a safe dividend. A website that you can use for this is simplydividends.com. You can start a 14 days trial, which should be more than enough to research the companies you want to hold. They use multiple metrics to come up with a safety score, and this should definitely help you to understand how safe the dividend is in certain companies. For example, in utilities companies, the safety score is very high, but then if you look maybe at REITs or maybe technology companies, you might see that the safety score is not that high. So this is something that you should keep in mind for your portfolio, and as well something that you can, for example, balance, that you see you have maybe a few stocks that have a lower dividend score but provide you more upside on the price movement and on dividend, and some that are more safe. Still, if you're not really sure how to get started to put together your portfolio, you can just look what ETFs are doing. I put here the name of two ETFs, the Noble ETF and VYM. Those are good ETFs to get a reference. Just look at the top 20 holdings and you can get an idea how they diversify their portfolios in the index, and maybe this can give you an idea on how you can get started. I don't want to encourage you to copy an ETF. I just want to give you an idea on what they're holding and maybe how you can adjust and apply this to your own portfolio.